All right. Have you heard of the tale of two cities in the multifamily industry right now? It's September 2020, obviously a crazy year, COVID-19, absolute disruption throughout the economy. The multifamily industry has been, relatively stable as a whole. Certainly, we are about a percentage or two down in terms of occupancy, collections, delinquency, but compared to the rest of the economy, things are going all right. We've got a new report out from Yardi Matrix. If you're not familiar with Yardi, leading property management software company and all-around excellent data and analytics firm, they put out a lot of very useful information. Their lead competitor is RealPage, and so we really track what these two companies put out because they have access to so much data because they are the software that all of these owners, property management companies, they're using, and they're able to access all of this data to analyze what's going on in real time throughout the country at different multifamily apartments. So, it is a tale of two cities out there with some markets absolutely seeing a bloodbath in terms of rent declines, occupancy drop. And then there's some other markets that aren't typically at the top of the list. And one in particular, I'm very excited to talk about that is at the top of the list and is relatively stable and actually really doing pretty well. So again, depending on what market you are in, things are either going really great or not that great at all. So stick around. We're going to break it down, get into it. This is Spencer Gray from Gray Capital, and let's get into it. Again, if you are interested in this type of information, and if you haven't signed up for the Gray Capital report we put out every Thursday morning, we send stuff like this to your inbox every Thursday when it comes out. So if you're at all interested in real estate investing, particularly the multifamily industry, you're not receiving the Gray Capital report, you're going to miss something. So you can hop over to our website, graycapitalllc.com, and sign up for that. So one of the more interesting things to kind of getting started on this report is the editorial note that prefaces this report. So we have for more than 5 years published these reports monthly with no reference to our proprietary matrix expert data set, which is drawn from the data run through the Yardi software operating platforms, as surveyed in transactional data sets that were broadly consistent. So basically saying what we see and what's out there is the same going on. However, over the last 3 months, a significant variance in occupancy has emerged in Manhattan, Chicago, San Francisco, Los Angeles, and Miami. Their transaction-based data is showing occupancy 4% lower than our publicly reported postal delivery database method. In the case of Manhattan, its occupancy is significantly worse. I believe it is our duty as to not mislead the investment community to make you aware of this variance. So what this is saying is there's some massive disruptions and issues in some of these primary and gateway markets, particularly Manhattan. And if you have friends or family in the New York City area, I'm sure you've heard that there has just been a mass exodus of folks. People have gone home. Anyone that was kind of on the fence, maybe they were thinking about having a family and didn't think that New York City was the best place. I love New York City. I lived in New York City for a while. My wife, Alex, lived in New York City for about 6 years. I moved out there to be with her, and we love the city. We still go there pretty frequently, but we decided it wasn't a place that we wanted to stay long term because we wanted to have a family and just we're from the Midwest, so we couldn't really figure out how to do that in New York City, and so a lot of people are leaving. I think New York's going to come back, but a lot of issues right now. So let's break this down. So again, and this is something that we've been talking about, and it is the basis of really our strategy and what we look for. Is that secondary markets are outperforming primary markets. We feel like there is a lot of market inefficiencies, and that's basically that when we talk about market inefficiencies, is that there's mispricing of assets. There are markets that do very well, but because for whatever reason there's not as much investor interest, sometimes the prices don't get bid up. And then conversely, and there are some markets, significantly primary markets like the New York Cities, the San Franciscos, the Miamis, Los Angeles, there's just so much capital that flows into those markets because a lot of the capital sources are, frankly, they're from those markets. New York City, everybody likes to invest in their backyard. And so if you're from New York, you're from LA, you're from Miami, they're like, hey, let's get something local. We know this area. And that just drives the prices up. Now, those markets, there's a lot of high income earners, and so it can work for a while, and there's tends to be a lot of appreciation. But what you see is this massive appreciation, but then you see the bubble being burst and major corrections. So we're seeing one of those corrections right now. And for that reason, we primarily focus on secondary markets and tertiary markets where we may not see the extreme booms, but we don't see the busts that are associated with those major booms. But we tend to like our steady growth markets where they are in a downturn, they continue to grow or flat, or maybe a very slight decline, but not a major loss. And then in a growing economy, we're certainly growing, but maybe not at the record clip that called a Las Vegas or a Phoenix or now maybe a Nashville, and those are all all those markets have their benefits, but we don't. The standard deviation, the swings aren't as much. There's less volatility. It helps us plan, helps us be more consistent. And again, we think that there's a major opportunity because of the inefficiencies in the market. You can take this incredibly cheap debt with the low interest rates, go into a market that has slightly elevated cap rate and get some pretty good yield. So multifamily rents in August increased by $1. That's across the board in the United States. So that's good because, we were seeing some declines, but seeing some pickup in rents, even by it's just $1, that is certainly a good data point that we're at least stabilizing and the bleeding has been stopped. Another good reason why that metric is important is because, when the CARES Act expired, we lost that additional unemployment benefits, and there was a concern that we would see a major drop-off. And so with this, not only flat rent growth, I would call this flat, but technically it's slightly up. That is a good sign to show that the consumer and the residents who choose to rent are in a relatively good position and can absorb some rental increases. And the unemployment rate being cut in half since the peak, that certainly has been helping. Now, we still are at a decline for the year. As you see, however, on a year-over-year basis, national rents have declined by 3% unchanged from July. So we still are at, again, I would say we're basically flat, but this is for the nation. The lifestyle asset class, and so that is what we'd call the renters by choice. Typically, full amenities, brand new, granite countertops, resort-style pools. That's being hit the hardest. And a lot of that is just because, they were pushing rents more than your workforce housing and renters by necessity asset class. And so they go in to say, with 22 of the top 30 markets experiencing negative rent growth in August. On the other hand, renters by necessity asset class held up well since the beginning of the pandemic, with only 8 of the top 30 markets experiencing negative rent growth in August, and with the national rent by necessity, RBN, rents increasing by 1%. That's pretty good. Another 1 million Americans filed for unemployment this week, ending August 22nd. With the expiration of additional unemployment benefits, many Americans are struggling, and that's a fact. So it gets into a little bit about the National Multifamily Housing Council's rent payment tracker. If you're not familiar with that, I would just Google NMHC rent tracker. We post about it. Again, we send it just about every week on our report. So you'll get that delivered to your inbox every Thursday if you sign up for the report at greatcapitalllc.com. 92% of all apartment households made a full or partial payment by August 27th. But that's a 1.9% decline from the previous year in August 2019. And it's also a 1% decline from July. So that's not good to see that a few people are, but it's about 1%. So it's certainly not going in the right direction, but it's not a major drop, and it's mostly on the margins. What we've seen, and again, this is going to come back because we're in Indianapolis, and I don't want to kind of spoil the good stuff, but we've actually seen our rents go up in a lot of our assets and in our markets, and yeah, there are some delinquencies, but our net rental income has increased. So kind of take that for what it's worth. On a year-over-year basis, national rents declined by 0.3%, but that is not to say that all markets are performing poorly. Out of our 132 matrix markets, 108 performed better than the national average in August, leading to the conclusion that the larger markets with significant rent declines are pulling down the national average. So that makes sense. So the New Yorks, the Miamis, Los Angeles, San Francisco, LA, huge population centers seeing rent declines, and that's bringing down the national average. But at the same time, a lot of middle markets, secondary, tertiary markets are actually doing fairly well. So let's continue. Out of our top 30 markets, the best performer, Indianapolis, had a 3.5% year-over-year rent growth in August. So we're from Indianapolis. We don't choose Indianapolis because it has the highest rent growth in the nation. Again, we like Indianapolis because it's a highly diversified economy. It's just a steady market. We don't see the booms. We don't see the busts. And we've been saying that since I've been involved. I was investing in real estate just prior to the Great Financial Crisis. But I really got involved post-crisis, and that was really the moniker, and really why we liked investing in the Midwest is that we really see much less volatility. And this isn't to say we were right, I told you so. This is just it's just nice to see that is actually playing out, and that's the case because we can't predict the future. Every crisis, every economic event is different and affects different markets differently. But it is gratifying to see that the Midwest is holding up very well. Also topping the list is Huntsville, Alabama, 5.7. That's great. Boise. And these are our markets not on the top 30 list. So these are our smaller markets. Huntsville, Alabama. It's actually a market we've been paying attention to really closely. 5.7%. That's awesome. Boise, Idaho, another great market, 5.1. Fort Wayne, Indiana, 5%. Love to see another Hoosier city on the list. Portland, Maine, 4.9, and Grand Rapids, 4.4. These markets have been benefited from lower population densities, affordable housing, and the ability to attract tech talent. Prior to the pandemic, we were closely watching, this is Yardi, they were watching Huntsville and Boise, as we think they all have characteristics to be included in the next set of tech hub markets. Since COVID-19, employment has declined in each of these metros, but are still outperforming the national unemployment rate at a 6% in each market compared to the national average of 10%. So this is a graph you can see national average rent starting in August 18th, going through August 2018 through August 2020. So we had a nice uptick February 19. Typically that's when raising rents and before leasing season, before the spring. So you're going to see that increase. It is a seasonal industry. And then typically, instead of getting that increase again, which we would have seen right here in February of 2020, we saw a decline because, COVID-19. But we do see kind of a leveling off here, and actually, it's looking pretty level. So, we're not seeing a steep decline. I think that, again, goes to show the major supply and demand imbalances in the multifamily industry. There's just simply not enough rental stock. There's not enough housing stock in general. And so even if there's, kind of a shakeup and individuals maybe moving from, living in a home to now renting Class A or going Class A to Class B, there's still a huge demand. And at the end of the day, everyone needs a place to live. And people are choosing apartments because of the flexibility, the amenities, the value. And I think that's going to continue. So let's look at the whole chart, and I hope you can see this pretty well. But again, so this is year-over-year rent growth, all asset classes. So that includes renters by necessity as well as the renters by choice or the lifestyle asset classes. So across all asset classes, we've got Indianapolis coming in at number one, again at that 3.5% at the top. Inland Empire in California, so they've been doing pretty well as well. Phoenix is almost always at the top of the list, and Phoenix, nothing is really slowing Phoenix down. So many folks from California are moving to Arizona, Phoenix in particular, because of better tax environment. They're sick of the wildfires. They just want to get out of California. I like Arizona. I like California. I don't think I could live in California for a couple of different reasons. I enjoy some things that you're not allowed to own there, but you can also own some things there you can't own here. But I love visiting California. Could never live there. enough commentary. So just on year-over-year rent growth for lifestyle asset classes, Kansas City, shout out to Logan Freeman from Kansas City, doing really great in the lifestyle asset classes. Again, this is the renters by choice. Honestly, I own my own house, but literally all the time I'm like, should we just sell our house and move into one of these awesome, Class A apartments that you've got the pool with the cabanas and the grilling pits and the bocce ball courts, and you can do everything. The playgrounds for the kids, hot tub. It's just got you've built garage built into your unit. It's awesome. Everything you need, and then if you decide you want to move somewhere else, you can go. So Kansas City at the top, Inland Empire coming in number 2, Indianapolis coming in at number 3, followed by Sacramento, Tampa, Phoenix, Charlotte, and then that's pretty much the only groups that have any kind of rent growth. It kind of declines after that. So renters by necessity, again, a lot more strength. Earlier in the pandemic, there was a lot of commentary about how kind of C-class and B-class assets would have a lot of problems, as those were the majority of people who had maybe non-essential jobs, working in the service industry, working in food industries, hospitality. I always kind of raised my eyebrow at that because, to one degree that made sense. At the same degree, if people are tightening their belt, they're looking for value. And what I see in those kind of not necessarily lower tier, but just more affordable assets is, you can have some volatility. You have some people moving out because they've lost their job. But you also have people moving down into those asset classes. So again, maybe you were paying $1,500 for a 2-bedroom Class A property, or even $2,000 depending on your market. Maybe you moved into some place you're only paying $900, or maybe $750. Maybe you're really on a budget. Maybe you just moved in with a roommate. You guys, let's save some money. We were both living at our own, 1-bedrooms at Class A units. Let's rent a 2-bedroom at a Class B, and let's pay $900 a month, $450 each, as opposed to each paying $1,500. Let's save some money. So again, that increases, the total, household formation sort of shrinks a little bit. But people are just making decisions. They still need a place to live, but maybe that's not the place that they have been living. They're looking for a more affordable option, and I think this really proves out the resiliency in that asset class. You have folks that are moving down. People aren't necessarily moving up. They're not necessarily looking for the most expensive place, unless it's in the highest of high end, who they've got so much money, they have such a good job, it's not affected by the economy. We call these people who, when they search on apartments.com, they're searching from highest to lowest instead of lowest to highest. So I think those people in those types of assets will be okay. But a lot of resilience. So all the way down, again, Phoenix at the top, Indianapolis, Sacramento. It kind of breaks even. National average is 1%. Kind of starts breaking even here around the San Antonio and Seattle area. So interesting stuff. So short-term rent changes. I'm not going to get into this as much, but let's just look at it just briefly. Month over month rent growth, all asset classes. Again, this is just from July to August. Indianapolis at the top. Raleigh, probably Raleigh-Durham area, number 2. Sacramento, Portland, Nashville. Lifestyle asset classes, month over month rent growth. LA, surprisingly, Orange County, Charlotte, Portland. Month over month rent growth, renters by necessity. Phoenix at the top, then Indianapolis, Raleigh, Vegas, Portland. All good stuff. So employment, supply, and occupancy trends. Again, this is really where we're trying to see where things are going. Where's occupancy? And that's obviously driven by unemployment and employment. And they're trying to forecast rent growth. Again, unemployment claims totaled 1 million for the week of August 22nd. Weekly jobless claims briefly dipped below 1 million during the week of August 8th, but have steadily held above the 1 million mark since. However, since May, employers have added more than 9 million workers to the payroll. August payroll numbers are expected soon, and economists are projecting another 1 million jobs will be added. If the rebound in jobs in August is as strong as expected, the unemployment rate could drop below 10% for the first time since the pandemic began. So, I'm optimistic. I mean, I think things are moving in the right direction, but it's too soon to say one way or the other. After this, they get into how tech hubs have been some of the best performing markets prior to the pandemic, but then really so many tech hubs you can now work from anywhere. So it's interesting. Again, that's San Francisco. People are leaving in droves because they no longer have to live in San Francisco to work in San Francisco for some of those companies. And so it gets into just how the rent growth is inconsistent in many of those markets, and even some negative rent growth. Austin has flipped negative, which is interesting. And again, New York has just been absolutely beat up. So let's get into some of the details and the numbers. So employment, supply, and occupancy trends, forecasted rent growth. They don't really get into much how they're forecasting some of these, and I'd be really curious to see how well these track, because they pretty much have every market in the country with negative rent growth for the year, outside of Sacramento, Inland Empire, Kansas City, good job Kansas City, and Tampa. Well, Tampa's zero, it's flat. So I found that interesting. And again, I recommend you just going through this. I'm not going to go through every number. I will point out they are forecasting Indianapolis is going to have negative 1.5% rent growth. That's something you would kind of expect in a recession. I mean, honestly, you would expect more like negative 3% rent growth in a recession. So we're not doing that bad. Many other markets do have negative 3 to negative 6% rent growth. Some markets are relatively flat. And again, it sounds like we're going to see more rent declines in the lifestyle asset classes versus the renters by necessity. Let's look at job growth. Negative across the board. I think the best looks to be the Dallas area. No surprise there. So many new jobs are opening up in Dallas. So many corporate headquarters. It is a great real estate market. Crowded, but great. Population's growing, jobs are growing. And that's what you want to see. Indianapolis, we got a 4% decline in employment growth. So don't like to see that. Again, I'd like to see how this actually plays out and if that's going to be accurate or not. Occupancy, they get into completions as percentage of the total stock. That's just how much more supply is coming into the market. So a higher number would put pressure on rents and absorption. So you need the higher number. So like Denver, you got a very high number. You've got a lot of population, a lot of people moving to Denver, a lot of supply coming into Denver. Again, and I keep coming back to Indianapolis. I'm biased. That's our home base. That's where a lot of our portfolio is. 1%. That's pretty healthy. Again, a lot of these markets are north of 1%. Actually, I think the only other markets at 1% is Baltimore. So hopefully we don't have as much issues with absorption in Indy. Now let's look at occupancy rates. Just the difference between year over year, July 19 to July 2020. It's anywhere between a percentage point and a 2 difference. So let's go to the top of the list. Just Sacramento. Last year, average occupancy rate was 96.3. Now they're at 95.9. That's a 4 basis point difference. Not significant. Or 0.4 actually. So Indianapolis, again, I'm just picking and choosing. Last year we were at 94.4. Now we are at 93.7. So 7 basis points. Could be worse. We'd obviously like to see that up. And then so really occupancy, we're not seeing a ton of declines in occupancy across the board. I mean, I'm not seeing any more than a couple basis points. It's really very, very similar to last year. Now, again, so we're seeing a little bit of rent declines and more concessions, probably more concessions on renewals. And obviously a little bit of collections issues and delinquency. But those, and that's where we use the NMHC's tracker to see what is going on with collections and delinquencies. And again, those are off by 1 to 3% from year over year. It's a good graph. So you can see, occupancy is definitely, and again, this is across the country. So again, these major markets are influencing this in a way that others may not. 95% back in September of 19. Now we're, it's like 94 point. It's kind of hard to see exactly where that is, but we're not too far below. And so overall, it breaks it down by lifestyle. That's at the top, and the renters by necessity. Sorry, I switched those. I'm colorblind. Lifestyle is the darker blue, purple. I'm colorblind. They make those colorblind glasses, and my mom got some for me, and they don't work. I really appreciate it, Mom, but they kind of work at traffic lights, which is good. I can see colors. I get blues and purples and reds. Don't make fun of me, please. Year-over-year rent growth, other markets. Again, here are some other markets that are on the list. Indianapolis is on that, but some other markets that are interesting. Tacoma, Washington, got 3.5%. Central Valley, 4.3%. North Carolina, the Triad Medical, the Triad area, 3.9% overall. Salt Lake City, surprisingly, it's only a little bit over zero, flat. Northern New Jersey, down. Southwest Florida coast, down. San Fernando Valley, down. Bridgeport, New Haven, but all basically flat. I'm not going to get into all of these, the market rent growth by asset class. Outside, maybe just point out a few. Boston was growing, seen some decline, relatively flattening out. Atlanta had seen some great rent growth. These are negative. These are just, so we're seeing flattening out. Dallas, flattening's going up. Again, we won't get into all of this. Las Vegas, it seems to be a positive trend line. LA, though, not good. Not good, LA. That would be a negative trend right there. Miami, negative, but possibly correcting. It seems like it's oscillating down. Phoenix, nothing's going to stop Phoenix, it seems like. Although, man, at some point they're going to build too many apartments. Orlando, Disney World being shut down, hotels being shut down. You can't fly to Orlando. Man, I was at the NMHC conference in Orlando right when we first started hearing about coronavirus. A lot of hotels, a lot of new supply, a lot of people working in the service industry. It was doing really well. It was a market I really liked, although I was always concerned that if there was a recession, you could see some hardship. And man, again, when you turn off all the hotels, you turn off the theme parks, you can't fly, you can't go on vacation. Place like Orlando cannot be doing that well. I think it'll bounce back. Just like the rest of the U.S. is going to bounce back. Sacramento down. San Francisco sharply down. Seattle down, swooping up. That's about it. Again, so you can go, and this is going to be posted on our blog, greatcapitalllc.com. And again, if you're interested in getting these types of reports, you can just sign up at Yardi, and they'll email you this. Which I recommend you doing. But there are so many good reports out there. There's so many good information, different sources. If you're not dedicated to seeking out all those sources, which I recommend you putting in the time in. But if you want to kind of shorten that search period, just sign up for our newsletter at greatcapitalllc.com. We've got a dedicated team that all they're doing is looking for the latest reports when they're coming out, new articles. And again, if you're not dedicated to actively seeking all that stuff out, you're going to miss something. And so that's what we're focusing on, or at least that team is. Obviously, our core business is Great Capital, identifying unique investment opportunities in the multifamily sector, primarily in the Midwest, in secondary and tertiary markets. But we'd like to be able to add value to our investors, our partners, and just the industry in general, to be able to provide a good aggregation of information and data. So it's for us because it keeps us informed, but if we can help you make some better decisions, that's a win-win for everybody. So I really appreciate you taking the time to go through this report with me. Hopefully you're going to read it for yourself, but I think we were able to get you caught up if not. So my name is Spencer Gray. Again, I'm president of Great Capital LLC. Again, we're based out of Indianapolis, Indiana. Appreciate you watching this video. If you liked it, hit like, give a comment saying if you appreciate it or not. If you say, I just wasted 30 minutes of my life, I could have just read this in 10, good on you. I don't know why you watched the whole video, but I think maybe we broke it down together. If you have a different opinion, comment and say, Spencer, you don't know what you're talking about. And I will say, well, I do not know everything, and I'm happy to have a discussion, but I like to learn and I like to exchange opinions with people who may have a different opinion than myself. That's how we grow and that's how we learn. So again, have a great day. Hope everyone makes some great decisions out there. If you got something out of this, share this with all your friends. If you're like, hey, I know you don't know how to read, but you can watch videos. This is a video you can watch. So, all right. Thanks, everybody. Have a good one.